An important feature of the Australian tax system is the concept of deductions. They are something that people tend to miss or are simply not aware of at tax time, but can be very helpful in saving money. A key tax formula for you to know is that your taxable income is equal to assessable income minus any deductions. From this, you should be able to see that deductions reduce your overall tax bill. Right, let's draw up an example. You have Charlotte here. She's 22 years old. She has a full-time job as a sales assistant at an electronics store, and she earns $45,000 a year. Let's also say that she spends $300 each year on a specific uniform required by her work, and she spends $700 each year on workshops to develop her sales skills. So these two expenses which she's made are examples of possible tax deductions. For us to calculate Charlotte's taxable income for the financial year, we take her assessable income, which is $45,000. We then subtract her deductions, which total at $1,000, and we find her taxable income is $44,000. Now, if we were to assume a 30% tax rate on Charlotte's income without and with deductions, we can see that she will potentially have saved herself $300 in tax by claiming these deductions. This is why they can be quite important. Okay, so that example was very simple, I think you'll agree. But unfortunately, the reality is that knowing what qualifies for a deduction can be quite tricky. Let's say that Charlotte instead works an office job and she's expected to wear something formal like a suit. Now, this suit may not qualify for a tax deduction because it's technically not a uniform, even though it's a requirement. Another example is, let's say that Charlotte undertakes tertiary studies in nursing because she's considering a career change. The education expenses will unlikely qualify for a tax deduction because the course won't be providing her with skills linked to her current employment. So as you can see, deductions are not always so easy to identify. However, just like assessable income, there is a rule of thumb which you can follow when trying to identify an expense as a deduction. It can be an expense associated with gaining or producing your assessable income. Alternatively, it could be an expense incurred in running a business. Remember, before you assume an expense is a deduction, thoroughly research this beforehand or consult with a registered tax agent. Now, an expense is generally not considered to be a deduction if it is private or domestic in nature. An example of this could be Charlotte's lunch expense on her standard work break. Also, an expense won't be a deduction if it is associated with earning exempt income. In the previous topic, I mentioned that it's important to establish a record-keeping system for tax purposes. Well, the same applies for deductions. When making any claims, it's crucial that you're able to provide evidence that you in fact have faced such an expense. This means you need to keep your receipts and tax invoices if you're going to proceed with a claim. Each year, the Australian Tax Office can audit individuals at random to see if they're accurately disclosing income and deductions. But that covers deductions. Hopefully, you're more aware of what they are now and how they can possibly reduce your overall tax bill.